I'm going to discuss in this video stocks and bonds. The downturn in the stock market that started last week and has accelerated so far today, August 5th, 2024, is attributable, in my opinion, to investors calling into question the consensus opinion that the Federal Reserve had engineered a soft landing in the economy, notwithstanding rapidly increasing the federal funds rate from 0 to 0.25% to the current 5.25 to 5.5% range. The Fed was at the 0.25 to 0 to 0.25% range, which is called ZIRP or zero interest rate policy, until March 2022, when it raised the range to 0.25 to 0.5, just a quarter of a point, even though the annual CPI rate for the 12 months ending in March 2022 was 8.5%. The Fed had also continued its expansionist monetary policy known as quantitative easing, which vastly increased the money supply, notwithstanding the rapid increase in inflation during 2021. The Fed's monetary policies were a main contributor to the rapid increase in inflation. Last week, the July jobs report released by the government and some other economic data that's less important called into question the consensus opinion of a soft landing. This blue sky scenario is generally defined as the economy avoiding a recession, notwithstanding the significant increase in interest rates engineered by the Fed's change in its monetary policies. It is too early to draw a conclusion that the soft landing will not happen, but not too early to question whether the consensus opinion that existed a week or so ago was too optimistic. In my blog, which is linked at the top of my YouTube channel page, I discuss changes in my asset allocations each week. I'm currently extremely conservatively positioned, with stocks hovering near 10% of my total portfolio. I included in the most recent post snapshots of my asset allocations in 2 of my 5 brokerage accounts. Those are my Fidelity and Vanguard account that I had snapshots of the current allocations. I've been reducing my stock allocation both this year and last year. My portfolio is weighted in Tennessee municipal bonds that have credit ratings of AA at a weighted basis of AA plus, investment grade corporate bonds maturing within 2 years, Treasury bills and short-term Treasury notes bought at Treasury auctions, CDs and Treasury money market funds, primarily in my Vanguard taxable account, where the weighting is close to 50%. Vanguard has the highest yield of those kind of money market funds, which is why I keep most of my spare in cash that could be used in investments in that account. I'm extremely conservative now, having transitioned many years ago from just a stock investor. The stock allocation, which is already small, bordering on insignificance as a percentage of my total net worth, is heavily weighted in bond-like stock sectors, which includes equity, real estate investment trust, REITs, pipelines, utilities, and consumer staples whose dividends become more attractive when alternatives like Treasury bills go down in yields, which is already occurring even before the Fed reduces the federal funds rate, as investors factor into yields now cuts that are anticipated. It is now anticipated that the Fed will cut the federal funds rate in September by at least 25 basis points and possibly by as much as 50 basis points. And that will directly impact by an equivalent amount the Treasury bill yields and the yields of money market funds. Today, August 5th, is shaping up as a major down day in stocks, which will not impact me much since my far larger bond allocation will increase in value. I will likely do some scattershot buying in dividend stocks today, which I define as buying 5 to 15 stocks and spending about $1,000 to $2,000 on those purchases in total.